So starting with the debt ceiling, this is one of the more anticlimactic things that we see. This is, I think, the 78th time since 1960 that they've extended or increased the debt ceiling. And so once again, they decided to do that. The fact that they did that's not that surprising. Had they kicked into a prioritization of payments, which could have been interesting, sort of a new step, I think their constituents would have very quickly and loudly vocalized their opposition against their position, and it would have quickly resolved itself. It is quite remarkable that it was bipartisan, and truly bipartisan. And so I think that gives some hope that on major issues, some things might get done. But I think the larger issue, if you sort of zoom out and you say, well, this is so weird, right? So why does our government pass a budget and then later decide whether or not to increase the debt limit such that they can fund it? I think you got to ask, what's the debt ceiling? What's a reasonable debt ceiling to have? And we are pushing the limits of what that has been in the U.S. historically. So if you look at U.S. debt to GDP now, it's about the same level as it was in the aftermath of World War II. We haven't been in a war. We've been in some financial skirmishes of sorts, but we've largely created this on our own. So where do we go from here? Some people, and this would include the modern monetary theorist, believe that debt to GDP doesn't matter. And I would tell you that one of the biggest widowmaker trades out there was short Japanese yen. And if you look at debt to GDP in China or in Japan or Singapore, they're much higher than even they are in the US. So it's possible that we could go on in this current trajectory and not have a significant issue. It seems like all roads ultimately lead to inflation, and that's in fact what we are experiencing now. The idea that the US would default on its debt is ridiculous and would be catastrophic to the global financial system. So you can, if you think about what are the different ways out of it, you can default. You could grow your way out of it. And if you think about the last time we were at these levels, interestingly, leading economist at the time thought that the global economy was on the verge of collapse. Why? Because it was all engineered around the war effort. And so what would happen without a war? Well, the GIs came home, got educated, moved out to the suburbs, had kids, increased the productivity level of the United States, and that's the biggest growth engine in the history of modern economics and finance. So growth can be underestimated, but it's hard to see that now, especially with population rates outside of the Latino community sort of falling. So it's hard to see the path to really do that. And the other sort of catalyst for growth tends to be R&D, and finally, we did get some things passed around infrastructure, but it's hard to really point to the U.S. growing above, I'll call it trend, call that 2% GDP growth. So another way you could do it is cut your way out. So you could cut spending. I think if there's two things that both parties seem to be agreed upon, it's we're going to raise the deficit either way, whether that's cutting taxes if you're a Republican or increasing spending if you're a Democrat. So I'd say that has little to no chance of happening. So then that leaves the fourth option, which is inflation, which is kind of a nice thing in that you don't have to pass a bill. You don't have to do anything. But it certainly is a tax. And it's a tax on the saver, right? So if you just keep your money in cash, inflation will outstrip it, or the bondholder. They're the ones that ultimately pay for it. So, and finally, you shut down the economy, you pass legislation that floods the system with money, including paying people not to work. And what do you get? You get inflation. So it looks like for the first time in a long time, the finance and economic textbooks that we all grew up reading are right once again. And the notion of modern monetary theory or these other concepts leave a lot to be desired, or are certainly in their infancy in terms of proving their worthiness. So I think that the discussion that should be had, that needs to be had, which started, if you think about it, back when Obama took office, and you had two Ernst and Bowles that were out talking about the consequences of this and the need to act sooner rather than later. That to me is the discussion. Where are we realistically going? If you look at the CBO projections, they don't have priced in a recession, which looks to be inevitable or even necessary in order to get inflation under control. So that's to say, I think debt to GDP levels are going to even overshoot what a lot of people are projecting. And so we are going to test those limits. And when that exact point occurs, nobody knows. But I think you got to be prepared and vigilant for it. So to the degree past is prologue, and you go back to World War II and say, what happened after that? We did grow, right? But yet, that wasn't enough. And in 1968, we get off the gold standard, and that really unleashes inflation. And so when you look at sort of the eras of inflation that we've had in our history, I think a good question is what era might we be entering? So if you look sort of post-World War II, you had a steady climb in inflation. Interestingly, the Federal Reserve in the 70s, when you think about what the Federal Reserve is trying to do today, the Federal Reserve at that time, staffed with very smart, competent people, tried and failed 2 times to squelch inflation, only to then have it really blow off the top and approach, I think it was 16%, and have Paul Volcker come in, raise the Fed funds rate to 21%, which nobody's even in the realm thinking about, in order to push the economy in a recession, in order to drive unemployment up, and in order to get inflation back under control. And that worked. In 3 years, in 1983, he had it down to roughly 3%. So even with the baby boom generation, which is an incredible economic growth engine, you still had to inflate your way out of it. And remember, along the way, they tried all different kinds of things in terms of taxing, changing tax brackets and so forth. So to me, there really only seems one logical path out, and that's inflation. We, after having that episode of very high inflation in the 70s, we've entered ever since then this period of sort of Goldilocks, not too hot, not too cold inflation. And I think everybody's grown accustomed to that. And so, you're seeing inflation at its highest levels in 40 years. You're seeing interest rates at their highest levels in 14 years. And I think as a smart investor, you can't think in absolutes like inflation absolutely will come down to the growth target at 2%. Interest rates are going to go back down, or let's say go back down to being anchored at 0, or maybe they'll normalize at 5% on the short end and have kind of a typical yield curve structure. Anytime you go all in on a certain strategy, invariably it doesn't work out for reasons that you can't even begin to even comprehend, and that are only known in hindsight. So I would encourage investors in this environment of incredible uncertainty on a level that we haven't seen arguably in 4 decades, that you have to think probabilistically instead of in absolutes. And it's about saying the likelihood that we get inflation, let's say, back down to the 2% target that the Fed has discussed over and over again, may not happen. Why? Well, for decades we've been offshoring manufacturing. Some estimates project that, or some estimates have calculated that that's taken about 0.6% off of CPI. So logically, as we onshore, reshore, nearshore, whatever you want to call it, one would expect the reverse to happen. Maybe not completely in the other direction, because it looks like we're still going to be offshoring some aspects of it, but as we nearshore, reshore some of it, you would expect that to happen. The other thing is the labor force is obviously incredibly tight, right? So think about this. The Federal Reserve has gone from 0 to 5.25%, despite we had a huge banking crisis. I would say that Federal Reserves of yesteryear, maybe going back to, let's say, Greenspan, would have used their blunt instruments very quickly, think interest rates, money supply, to have saved that situation. Instead, they ring-fence the issue and they continue to raise rates. That's a radically different approach than the Fed has done. Really, I think going back, the Mexican peso crisis, the Asian financial crisis, I think this is a different Fed, or perhaps just a more learned Fed, having seen prior policy decisions and effects. You've got a Federal Reserve that seems very intent on squelching inflation at all costs, and yet unemployment still sits at 50-year lows. So what does that tell you? Pretty obviously, we've got a shortage of labor, a big shortage of labor. So nearshoring, reshoring keeps an elevation on inflation. A shortage of labor keeps an upward pressure, let's say, on wages. And yes, some of that can be managed with automation and AI, machine learning. But at this point, you still need human beings and bodies, and they're in short supply. The other thing I'd tell you, which has been a fascinating evolution, when you go back pre-global financial crisis, and you think about what was going on in the boardroom of any sort of business in the commodity complex, whether they were in energy or copper or whatever, there was very little money left in the cigar box. And what I mean by that is they were making money, the money was going in the cigar box, and they were immediately going out and buying another mine or more rights to more commodity production. Or they were acquiring other businesses, they were continuing to sort of roll up in economies of scale, was to be helpful. That shifted, and all of a sudden, with the combination of I'll say the shift towards ESG and just the shift in the boardroom, these companies that used to take all the money they would make and then go reinvest it started paying out dividends. And so I think an easy argument to make is that the whole commodity complex is undersupplied. And yes, maybe we're going to be able to make continued progress with some of the other alternative energy sources. But for now, again, it looks like we're still going to be using a lot of what we've always used. So for a whole variety of reasons, you've got structural forces that seem like they're going to continue to put upward pressure on inflation. And so again, I think whether that means we're going to hit 2% or whether that means we'll level out at 3 or maybe even 4, nobody knows with great precision. But you've got to invest for that possibility to unfold because it's incredibly possible. How likely? That's for us to figure out with our clients, right? And then you got to size that accordingly, and you have to really think through, do I want to be in a binary trade where if inflation doesn't happen, I lose? Or do you want to try to indirectly invest in a way that's going to pick up should inflation persist at higher levels? For example, you could buy a barrel of oil, and certainly if you did that in the 1970s, depending upon when you did it, you might have gotten a good initial pop. But then for decades, oil did nothing but go down into the first Gulf War. So meanwhile, Exxon and Chevron were banging out huge profits. So I like the idea of investing in energy, material, and mining companies, and there's some great managers that we work with and use with our clients that are identifying the types of companies to invest in that certainly are long levered to the commodity. So if the spot price of oil goes up, by all means, these companies are going to make yet more money, but they're going to figure out how to make money in any environment. So we like investments like that. Certainly maybe having a sliver of commodities or a sliver of gold might make sense, but the core of that, what I'll call real return or inflation sensitive component of the portfolio, I think you want to be able to work kind of regardless of the market, but have kind of an upside optionality in the event inflation persists at a higher level or spikes like it did multiple times during the 70s. So I think the key question then comes down to how do you invest in an environment that is so uncertain? that does have these economic variables that are unique, but yet we've seen before. And for the last, you could really say 4 decades, if you were just long stocks and long bonds, you did great, right? Interest rates were 16%, call it, on the 10-year treasury, and got down to one point, I think about 60 basis points, maybe even less. So that was a heck of a trend, right? As interest rates fell, think about what someone would have paid for a double-digit yielding treasury bond. A lot, right? So you didn't have to be that thoughtful or sophisticated about how you invested. You just needed to be long these two blunt instruments called stocks and bonds. I think what we're in today is a different environment that requires more thought, more sophistication, because the range of economic outcomes is so much wider, and you don't necessarily have these big tailwinds at your back. Call it, ever falling interest rates, ever falling cost of capital, ever falling inflation rates due to offshoring and other things. So when you think about why portfolios held up well last year, right? So in general, ballpark, bonds were down 13, stocks were down 19. If an investor didn't think that that was possible, they really weren't thinking that hard because of where we sat with interest rates and how well the stock market had done and how narrow the market had become with a handful of tech companies. So you had to think outside the box. And so I think there's other asset classes, some of which I alluded to earlier, like energy, material, and mining companies, but you can also buy things that have a ratchet that moves with inflation. So the most simple thing, I'm sitting in an office building right now, we have a rent roll, and we pay that, or I should say the owner has a rent roll and we pay that, and it's not going to go down. So it's going to move to some degree with inflation, and yes, there's a lot of speculation about what the office environment will look like, but the early indications is work from home works surprisingly well, but it's not the panacea. And so people, not in every industry, but most industries will be back in the office. So a rent roll has a just positive correlation with inflation. So does something like a master limited partnership, which is the agreement that controls how energy gets moved around the country in pipelines. So it's got an automatic ratchet, similar to the consumer price index, or what people call CPI. There's an index called the producer price index. So it measures what are the input costs that a company is experiencing in the manufacturing of their good or service. So if PPI moves, automatically the contract moves with it. So we like things like that, and it was because of those types of investments that our client portfolios held up so well in an environment where stocks and bonds did so poorly. And again, as you look forward, I think you've got to at least think we could encounter another situation similar to what we did before as we move from this radical, very experimental fiscal and monetary policy, hopefully to something that's more normal and sane. What's the likelihood of a recession? And again, I think it's important to think probabilistically, not in absolutes. Who knows? Maybe the Fed perfectly engineers a soft landing. What's the likelihood of that? I don't think it's that high. You got to remember, while these are very smart academics that I respect tremendously, the same, or their predecessors, felt like the housing crisis was contained in 2006-07. They thought that inflation more recently was transitory. And you can go back through history, and time and again, they've been wrong. And so, and they're not necessarily even trying to engineer a soft landing. What their number one priority right now is, because they've got full employment, right? They have a dual mandate, full employment and price stability. So they're really working on that price stability because they got a lot of run rate in terms of unemployment. I'd take them at their word that they're really trying to work on price stability. And unfortunately, the only way they really know how to deal with that is by pushing the economy into a recession and driving unemployment higher. If you look at the current FOMC projections, they're telling you that they want a recession and that it's going to occur in the back half of the year. they're telling you that they're going to raise unemployment by a material amount. You're talking, let's say the U.S. labor force right now is called 165 million people. They're going to lay off 1.5, 2 million people. So the Federal Reserve wants a recession, needs a recession in order to execute on its mandate, and they're doing everything possible to do that. What are they doing? We've got one of the most inverted yield curves we've ever seen. What does that mean? The short interest rates are incredibly high, right? We talked about the banking crisis, and despite the banking crisis, the Federal Reserve pushed interest rates higher another 1/4 point. So now we sit today at 5.25, and if you look longer out, the 10-year's call around 360. So what the investor community is saying is, we buy that. We think that the economy is going to slow down, and so a 3.6% yielding 10-year bond is not a bad idea. But in the meantime, you can get 5.25, and yeah, there's been a lot of press out recently that various FOMC officials have been hinting that they may not hike in June. But if you look at the Fed funds futures markets right now, they're priced in another 25 basis rate hike in July. So you're going to be probably at 5.5%. Just think about that for a minute. We were at 0. So this idea of there is no alternative, y'all might remember the acronym TINA, it pushed people to take risk, right? So if you were earning 0 in your checking savings account, money market account, you had to own something that had more risk, therefore more return potential, in order to try to get to your return objective. Today, you don't. So you can be patient and get paid pretty handsomely relative to what I think the investor community has grown accustomed to over the last 15 years. 5.5% is not a bad rate of return. So if you look at what effects their moves have already done, and another interesting thing to notice, not only have they increased rates dramatically higher, they've done it very fast. And I think the analogy of monetary policy being like steering a shipping container vessel is right. So they spun the wheel really fast, really far, and have driven interest rates up. There is a lag. There's a debate on when that lag takes effect. If you look back at history, every time, over the last 10 recessions, you've had an inverted yield curve just like you did. So it did predict that. There have been some false positives. So again, nothing's a guarantee in economics, finance, and investing, which again, I think you got to think probabilistically, but the overwhelming likelihood is that we will, in fact, have a recession. If you look at other data, you're starting to see that being supported. So you can look at like the ISM manufacturing data. A number of things point to a slowing economy. And it's interesting how it's hitting different pockets. So housing really sold off, or I'll say really came to a standstill, but now seems to be resuming. And so maybe there still is a shortage of housing or not. But it certainly came to a halt for a period of time. And certainly buyer preferences have shifted. So when people couldn't go outside their home or travel much, yeah, they bought a lot of stuff. But now they're buying experiences. And so the service economy, you can see, is even experiencing more inflation than, I'll say, the manufacturing economy. But I think it's almost inevitable. Well, it is inevitable. You're ultimately going to get a recession. It's just a question of when. And it typically takes 6 months to 2 years for that to set in. And if you think about how long the yield curve has been inverted, we're pretty deep into that. Why hasn't it already happened? Because it really should have. And I think the reason is because of what happened during the pandemic. So what's a variable that really has never been factored into an econometric model? Well, you shut down an economy and flood the system with liquidity and send people a bunch of checks. How long does that take to burn off? I think that's the experiment that we're in. And if you listen to bankers, whether JP Morgan, like Jamie Dimon, Bank of America, whatever, they're all saying the same thing, which is there appears to be some excess savings, but it's running out. So at some point the money will run out, and it already is looking like it's starting to. For example, credit card debt is at an all-time high. Mind you, it's clipping along at about a rate of something north of 20%. So again, going back to that idea of a higher Fed funds rate, all the other rates go with it. So if you look at the prime rate, so what a corporation's theoretically borrow, it's 8.25. If you look at the 30-year fixed mortgage, it's 7%. Not too long ago, you could get a 30-year mortgage for less than 3. So it's a radically different environment where price matters, the cost of capital matters, and that tends to slow an economy on its own. The other thing that I think is interesting, the Fed has said that they're going to come on the backside of this and then re-stimulate. And perhaps it's that simple. I'm mindful that Ben Bernanke had a famous interview in 60 Minutes. When he was Fed chair, he said he could take care of inflation in 15 minutes. Turns out it's a little harder than that, right? So I think re-stimulating an economy in the aftermath of this incredible experimental time of fiscal and monetary policy might not be as easy. And so again, you might think about more of a prolonged recession. And so again, in thinking about the different ways this could play out, I think something that we've started and stopped, started and ended all conversations with clients about is liquidity and is there reserves. And by reserves, I mean cash equivalents, and I'll say ultra short-term bonds. And as I mentioned before, today, even in money market, you can get about 5.25 on bonds. Let's say they're roughly 6 months of maturity taxable bonds. You're probably getting something like 5.70, 5.80. So you're getting a decent return, being very conservative. And so what we would encourage institutions that, let's say, have a spending policy and know that they're going to be distributing money, or individuals that are in retirement and know what their budget looks like, or have a known capital expenditure that they see in the next 1, 2, 3 years, whatever it may be, you go ahead and set that aside, because the incremental return probably isn't that great. So de-risking by matching, I'll say, the maturity of the bonds or the instrument that you own with when you anticipate spending it, I think is a great strategy to have with a portion of your capital, because markets could roll over. If you think about it, if you get a recession and you go back through time and you look at what that means, right? So if you're in a recession, logically corporations make less money. How much less money? Tends to be quite a bit, more than you'd think. A typical earnings recession looks something like down 20%, and that's even excluding something like the global financial crisis or the tech bust. So if you think about that, we're already, as a market, we're trading pretty expensive, over 18 times earnings. The 25-year average is called around 16.5. So you're already trading at a premium going into what in all likelihood is a recession, based upon earnings that might not come through. So if they don't, that just means the market's going to be that much more expensive, right? Price divided by earnings, that's the price to earnings ratio. So we worry that the market could get more expensive for a period of time until earnings start to regenerate, or you're going to get a normalized valuation by prices falling. How much could they fall? Who knows? But I certainly wouldn't put the October-November lows from last year out of the question, something like 3,600, which is not on people's radar. And another thing you got to remember about investing is rarely is it rational. Warren Buffett's teacher talked about how the market tends to be a manic depressive. He gets very excited, will buy stocks at any price, and then he'll basically give them away. Howard Marks, another great investor, talked about how the market really moves more like a pendulum, swinging from one extreme to another. And when you think about that, more recently, we traded in the dot-com boom at something north of 20 times earnings, I think 23 times earnings, only to then fall down to single-digit price-to-earnings multiples. Then during COVID, we got back over 20%, and like I mentioned earlier, we're call it 18.5 or so right now. So one of the things I think you need to be thinking about is, what if the market overshoots on the downside and gets panicked about a recession and falling earnings and falling stock prices? and they say, gosh, I do have an alternative called money market or cash or short-term bonds. It's yielding 5.25%. Why don't I just hang out there and wait for the dust to settle on this market decline? It could expedite that sell-off, and then it becomes, a process of trying to catch a falling knife. So the management of liquidity and reserves, I think, is always an important aspect of what we do with our clients. But I think it's even more important in today's environment.